Good evening, unit holders of Digital Core REIT. Thank you for joining us at the SIAS Digital Core REIT virtual dialogue session. We organized this dialogue session for you to connect with the senior management of Digital Core REIT and to find out more about the resolutions that need to be passed at the coming EGM. The EGM will be held virtually on 18 November at 10 a.m. Singapore time. On 22nd September 2022, Digital Core REIT entered into a contribution and sale agreement with the sponsor, Digital Realty Trust LP, to acquire interests of a data center in Frankfurt and in Texas. The purchase consideration for the REIT will be $140 million for 25% of the Frankfurt asset, or up to $681 million for 89.9% of the Frankfurt asset and 90% of the Texas asset if an equity fundraising is carried out. Now, how sustainable is the data center business? And how will inflation and rising interest rate affect this transaction or business? What is the selection consideration and process behind the proposed acquisition? And how will your investment be impacted in the event of an equity fundraising? Unit holders can find out more through today's session and make an informed decision. Tonight, we are delighted to have invited Mr. John Stewart, Chief Executive Officer of Digital Core REIT, to join us at this virtual dialogue session. We will kick off the session with a presentation by John, followed by a Q&A session. Please submit your questions via the Q&A function of the Zoom webinar, and the management will endeavor to address them. Without further ado, John, over to you to take us through with the presentation. Thank you.
Thank you. And thank you to all of our unit holders for joining us, for your interest and for your support of Digital Core REIT. Before we dive into our presentation, since this is our first time participating in a SIAS-hosted event, I'd like to take just a moment to provide a brief introduction of Digital Core REIT. We are a pure-play data center REIT sponsored by Digital Realty, the largest global data center owner and operator. We own a portfolio of 10 institutional quality data center facilities concentrated in 4 markets across North America. We maintain a flexible balance sheet with current leverage of 26%. We have a global investment mandate, and our sponsor has granted us a global ROFR. The current pipeline of sponsor assets that meet our mandate is over $15 billion, which we believe provides us an industry-leading runway for growth. Finally, we're poised to deliver on our external growth strategy with the inaugural acquisition we would like to present to you today, and on which we would very much appreciate your support at our EGM next Friday. With that, let's turn to our presentation on page 5. We believe we are offering a compelling transaction that delivers significant financial and strategic benefits for unit holders, including meaningfully improving geographic and customer diversification, achieving scale, and enhancing overall portfolio quality while generating healthy accretion. We are proposing to acquire 2 high-quality assets in top-tier global markets. We're also delivering what we believe is very respectable DPU accretion, particularly in the current environment. These assets are primarily powered by renewable energy. The in-place lease agreements have been structured to pass through 100% of utility costs to tenants, so the portfolio is completely insulated from rising energy costs. And these assets are predominantly leased to investment-grade customers on relatively long-term leases with built-in contractual rental rate escalators. Let's turn to the transaction overview on page 6. We've intentionally structured this transaction to give us significant flexibility, given the uncertain macroeconomic environment, as well as the recent volatility in the capital markets. Specifically, we have the opportunity to acquire either a 25% interest in the Frankfurt facility for approximately $140 million in a transaction funded entirely with debt. Alternatively, in the event the equity markets recover over the next several months, we also have the option to acquire up to an 89.9% interest in the Frankfurt facility and a 90% interest in a Dallas data center in a transaction for which we would shell out approximately $680 million. On current form, we expect to execute the smaller debt-funded transaction only. We will have up to 3 months following the EGM to execute on the larger transaction. And from our perspective, we view approval of the larger transaction as a free option in the event of a significant rebound in our unit price. Just to be clear, however, we have no intention of issuing equity at a deep discount to NAV. In fact, we're a much better buyer than a seller of our units at current levels, and we have board approval to implement our existing buyback mandate once all legal and regulatory restrictions have been lifted and the transaction has been closed. Let's turn to the next page and take a closer look at the assets. As I mentioned a moment ago, these are high-quality assets in top-tier global markets. Each of these assets was purpose-built as a data center by Digital Realty from the ground up within the past 5 years. These assets are predominantly leased to leading global cloud providers and IT service providers. We own the freehold to all the assets in our existing portfolio, and we will own the freehold to these assets as well. Let's focus on the benefits of the Frankfurt facility on page 8, since we're most likely to execute on the debt-funded transaction in the near term. As I said a moment ago, we believe this transaction delivers significant financial and strategic benefits. Specifically, the proposed transaction is expected to meaningfully reduce geographic as well as customer concentration and establish important new commercial relationships while enhancing overall credit quality. In addition, the transaction would enable us to establish a presence in Frankfurt, a top-tier data center market characterized by robust customer demand due to its central location, excellent connectivity, and leading role as a major financial hub. The Frankfurt facility provides a stable cash flow stream, but also offers upside potential due to the embedded growth from lease-up of vacancy, in-place contractual rental rate escalators, and the opportunity for positive rental reversions at expiration, given robust demand, limited new supply, and low market vacancy. Let's take a look at the pro forma impact of the debt-funded transaction on page 9. This transaction is not just about the individual assets, but also what the combination of these assets with our existing portfolio does for the overall platform. The proposed transaction would enable us to establish a presence in Europe, would increase the number of markets where we have a presence from 4 to 5, and would reduce our largest market concentration from 39% of total rent to 33%. Similarly, the transaction would introduce 7 new customers to our roster and would significantly improve customer diversification, reducing the total annualized rent contribution from the top 5 customers from 97% to 91%. This transaction also delivers significant financial as well as strategic benefits. As you can see from the chart on the left-hand side of page 10, the debt-funded transaction is expected to be approximately 2% accretive to DPU. We will also remain comfortably below our target leverage range at 33.5%. And we've executed an interest rate swap to fix the rate on a portion of the euro-denominated term loan, allowing us to lock in that 2% accretion on the debt-funded transaction. In addition, the transaction also enables us to hedge a greater portion of our floating rate exposure, so we'll go up from 50% hedged at September 30th to 64% pro forma for the transaction. Let's take a look at the resolutions and range of outcomes on page 11. As I'm sure you know, the EGM is scheduled for next Friday, and we will be seeking unit holder approval for 5 resolutions related to the transaction, outlined here on the left-hand side of the page. I'm not going to dwell on the various resolutions or potential outcomes, but we'll obviously be pleased to take any questions you might have in just a moment. I would like to point out that even the smaller debt-funded transaction represents over 5% of net tangible assets, and both scenarios require unit holder approval, which is the reason that we rolled out this dual structure announcement. Finally, let's turn to page 12. Since this is an acquisition from our sponsor or an interested party transaction, we commissioned 2 independent appraisals, which were prepared by CBRE and Cushman & Wakefield. In addition, Deloitte served as independent financial advisor, and as shown on the left-hand side of the slide, they found that acquisition was based on normal commercial terms and was not prejudicial to the interests of minority unit holders. And as shown on the right-hand side of the slide, the independent directors have unanimously recommended that unit holders vote in favor of all resolutions. So that is the end of our prepared presentation. Thank you for taking the time to join us and learn about our transaction. And thank you again for your support of Digital Core REIT. And now, Mr. Lee, we'd be pleased to take questions.
Thank you, John, for that detailed, succinct presentation. Now, there are several questions from unit holders, and I'll start with asking one critical question. Unit holders have observed that when the REIT reported the first half results this year, the REIT's revenue was 0.3% below forecast, but when the REIT provided a business and operational update for third Q 2022 on 26 October this year, revenue surpassed the forecast by 1.6%. Now, we are hearing so much about global inflation, rate hikes, and the possibility of a hard landing, i.e. a recession. There's considerable uncertainty in the global economy now. Could you help unit holders better understand the market dynamics in the data center business? Is the data center business recession-proof? How did the REIT catch up and surpass the third Q forecast numbers after lagging at the first half? Will the acquisition remain DPU accretive? And if so, interest rates continue to rise. How do you reconcile that? Now, what changes have been made or will be made to the lease in relation to the customer bankruptcy at 371 Gulf Road?
Great, thank you. That's quite a question there. I think we will most likely tag team the answer. I'll address some of the macro commentary, and then I'll ask our CFO Dan Tith to walk us through some of the numbers and the details. So to the first part of the question, is the data center business recession-proof? Well, I don't think it would be entirely fair to say it's recession-proof, but I definitely believe the data center business is recession resilient. And specifically when you think about the applications that run through a data center, so if you can imagine in your personal life or in your business, if your business has a corporate website, or if you use email or you use Zoom for a virtual meeting, you obviously need to keep your data center up and running and need to pay your data center bills. So that the trends that are driving digital transformation are really secular, not so much cyclical. And so again, not entirely fair to say it's recession proof, because certainly to the extent that customers have difficulties, then that can impact the business. But the underlying demand is quite robust, and it really supersedes the business cycle. In terms of how we caught up and surpassed the forecast, Dan, do you want to take the second and third part of the question?
Yeah, sure. I'm happy to do so. And thank you guys all again for having us join you and speak to you today. So I think there were two questions on kind of the 3Q performance for Digital Core REIT versus kind of prior quarters. I think on one side, there's a question about revenue outperformance and why did it accelerate? As you may know, revenue is not just rental income that we receive from our tenants, but also includes utility reimbursements. And obviously, the way our contracts are structured with our tenants, our customers pay 100% of utility costs. So obviously, one of the big things happening nowadays is a rise in energy costs. And again, as John highlighted, our portfolio is 100% insulated from any rise in utility costs. So part of that increase was actually really the utility reimbursements that our customers are paying us to cover the expense on that side. In addition to that, our leases actually have built-in lease ramp-ups, and that meant in the second half this year, starting at 3Q, we actually received more cash revenue. And that actually addresses the second part of the question about how did we catch up on DPU and 3Q and perform well on that front. And really, it's just an additional cash rental income in the second half of the year. Again, that's kind of helped us kind of manage through the higher interest rate exposure that's occurred through all parties, including ourselves.
And then I'll take the last part about the bankruptcy at 371 Goff Road. So the story there is that we reached an agreement to amend the lease with the customer. We had basically a 2-month security deposit, and we expect they will be, we amended the lease to allow for an orderly exit. So we expect they'll be out of the space by the end of the year. I would remind everyone that we did reach an agreement with our sponsor to basically provide a backstop or a cash flow guarantee to make us whole for any shortfall related to that bankruptcy. So we should be covered through next year. And in the meantime, you know, Dan and I are, as we speak, in the process of working on backfilling that capacity, and we do have customer interest in that space, and I'm pretty optimistic that we will be able to release it within the next 12 months before the sponsor guarantee lapses.
And John, I think there was actually, Mr. Lee has one more question, finance related, was about the accretion and how do we guarantee that for rising interest rates. So what John and I did, and the broader Digital Core REIT management team did, was after we announced the acquisition on September 22nd, in late September, we actually entered into a interest rate swap to guarantee and ensure that we would deliver 2% accretion on a debt funded deal. So we locked in that interest rate that's secured, and the 2% DPU accretion that John mentioned in prepared remarks is locked in for unit holders. And so we definitely got ahead and made sure that we were not subjecting this transaction to any interest rate exposure going forward.
Thank you, gentlemen. Some other questions. Now, why is the REIT making Frankfurt the first acquisition target? And why was 371 Goff Road selected to be included as the only Canadian asset in the IPO portfolio?
Sure. So I take those in reverse order. I think, part of the objective with both of these assets, quite frankly, is to meet the global mandate, right? So the rest of the assets at the IPO were all U.S. assets, and the Toronto asset gave us a bit of international exposure at the IPO, and that obviously is a big part of what Dan and I were hoping to achieve with our maiden acquisition. In particular, if you listened, I know I rambled on for a while, but if you caught part of the presentation, I think it was page 9, where I talked about the benefits of the Frankfurt facility, and I emphasized that it's not just the individual assets, but what it does for the combined platform. And so a lot of what Dan and I were looking to achieve was achieving scale and diversification. Quite frankly, I think the equity funded transaction allows us to accomplish even more, much greater diversification and enhanced scale. But obviously on current form, we're going to focus on what is achievable with the debt funded deal. But again, Frankfurt allows us to establish a presence in an entirely new continent, right? True international exposure. And quite frankly, Frankfurt is one of the best data center markets in the world, bar none. So in addition to the diversification benefits and the fact that this is a brand new really campus developed by the sponsor, it's a very high quality asset that Dan and I think that we've achieved a very attractive price for unit holders.
Thank you. Unit holders are also concerned by the high cost of energy in Europe, and whether the growth will be impacted by such a factor. Are these triple net leases?
Dan, you want to take the lease structure?
Yes. So this Frankfurt facility is structured as what we call a modified gross, which is gross plus electricity. So the customer pays a gross rental fee, but they also pay 100% of utility costs. So we're 100% insulated from any rise in energy costs in Europe. This was a critical factor when John and I diligenced the assets. So, look, before we jumped into any potential acquisition, we made sure to look through the customer, the property quality, the contracts. I think there was a question actually about, what diligence we did on these customers. Another thing we looked at was, okay, well, if these contracts pass through all the utility costs, what's the financial stability of these customers to pay those costs? And over 90% of the customers at the Frankfurt facility are investment grade customers. They're the leading tech companies in the world. They have billions of cash on their balance sheet. And that gave us the comfort and assurance that, we aren't impacted by utility costs. And furthermore, our customers can handle that utility costs in Europe as well.
Thank you. Unit holders have also observed that the sponsor has close to 300 data centers in its portfolio. Now, unit holders are concerned that are they getting the best or at least the good picks from the sponsor's portfolio?
Yeah. Dan, why don't we tag team this one? I'll start, and please, chime in if I overlook anything. As how they can be assured, I would, first of all, I'd point to this transaction, right? I mean, this, like I said, these are top tier assets in top tier markets. This is a very high quality portfolio that we are acquiring. In addition, it's very important to note that our mandate is core assets, right? We are investing in core assets and core markets, and the REIT has been structured to align interests with the sponsor. So the sponsor maintains not only a sizable ownership interest in the REIT, but if you recall, your introduction, right? We're acquiring a 90% interest, or actually 25% interest with a debt funded transaction up to 90%. So regardless, the sponsor plans to retain a 10% stake in the assets. Again, these are core assets. These are not non-core, right? They are assets that are part of the sponsor's connected campuses around the world. These are assets that they are occupied by really strategic customers that who are critically important to the sponsor's overall business. And so it's important to the sponsor to, first of all, provide a seamless experience to the customer, right? So the customer doesn't feel like they're being orphaned, but they're continuing to get the same service level from a global provider that with a long-term track record. And so again, I think the fact that these are core assets and the sponsors retaining a significant interest in the asset as well as the REIT goes a long way beyond what we're demonstrating with our first acquisition here. Dan, what would you add to that?
Yeah, I think, I'd add is, look at the ones helping drive the decisions and views are John and I, and we don't take our responsibility to unit holders lightly. We understand that our purpose here is to deliver long-term value for unit holders for Digital Core REIT, not so much the sponsor, right? And with that, when we looked at where we could acquire, again, as John highlighted, we're looking at attractive markets. And frankly, in Frankfurt, that's a market where no one will sell a data center to you. It's a very precious data center market down there. There's very limited supply. Pricing has continued to increase in that market. And it was the conversation that John and I had with the sponsor saying, we want something in that market, right? And we want something that's new, purpose-built, with strong investment grade customers, right? So we are actively pursuing, assets on behalf of unit holders to benefit Digital Core REIT, and we're trying to pick quality assets. And I think we feel lucky that we have a sponsor here that does have a lot of assets that we can pick and choose what we think are the best. And gives great value to unit holders.
Well, thank you, gentlemen, for the clarification. Unit holders have observed that in recent months there has been significant share price movement. Any comments from the management?
On the management or on the unit price?
On the unit price. Comments from management, why there has been significant share price movement in the recent months. So I think unit holders want to know, is there any reason, any comments on management?
Sure. Dan, why don't we tag team this one again? I'll provide some thoughts and appreciate your input as well. I think to some, I mean, some of it is certainly macro driven, right? So specifically, we're in a dramatically different interest rate environment and inflation environment than we have been for most, certainly for Dan's career and mine. And yeah, so interest rates have moved rapidly. I think, we had some P&L exposure to rising interest rates, but I think the other part of the equation really is the fact that as interest rates rose, discount rates went up, right? Or asset values went down. In addition, I think, beyond the P&L, I think there was some skepticism in the market about our ability to continue to generate accretive growth, which, hopefully we are going some way to dispel that notion by our ability to transact here and generate healthy accretion despite the environment. You may also be aware there was recently, I think a week ago, last Friday, there was what I would just characterize as fake news in terms of a potential withholding tax issue that is not relevant or applicable, but our stock price was down 7% on the day that news came out. So, it's been a tough year, right? There've been a number of little incidents like that, like the withholding tax rumor, in addition just to a difficult macro environment. I would say we are, we tend to be correlated with data center, with U.S. data center players like the sponsor, perhaps to a greater extent than some of our Singapore listed peers. Data centers performed very well throughout the pandemic, and I think you've seen a little bit of a give back of some of that outperformance. But I can also tell you, first of all, again, I underscore that just how much we appreciate the support of our unit holders on the call. And I would encourage you to be patient because, quite frankly, I think the outlook is very bright for Digital Core REIT and for the data center business. Fundamentals are, this is the irony, right? The unit price is down close to 50%, but fundamentals are better than they've been in years. So, and values are sticky as well. And we've got a very robust sponsor pipeline and a strong, healthy balance sheet. So I feel very good about the setup for us going forward. And again, we very much appreciate the patience and the support of everyone on the call. Dan, what would you add to that?
Yeah, the only thing I would add, I think this would make some questions coming from the audience right now, was, there was a story around, well, some of these large tech players, hyperscalers, CSP build on their own, right? And I think that caused some noise in the market, and that was probably what John was alluding to, where when you look at the FTSE Singapore REIT index, I think overall year to date, that's down maybe roughly 20%. But when you actually carve out, pure play data center REITs, I think in aggregate, they're down roughly, call it 40% year to date, which is in line with where we're down as well. And I think some of that was, as John said, the shift from the highs of COVID, where obviously, we were beneficiaries at that time. And I think early this year, there was a story around, well, hyperscalers built for themselves, and may just proactively address that question. That's not new news. I think, hyperscalers, CSP, the lean tech companies, they have been building for themselves for many years, but they have also been strong partners of us, actually. And we have not really seen a shift in how that demand has affected us. If anything, Digital Realty, our sponsor, has actually had the highest amount of new business this year, candidly. And part of it also, I think when you look into, I think there's a question about recession. I think as we go into these more new economic cycles, some of these tech companies might reassess, is it best to build on their own or actually work with a provider like ourselves? And in past history, we've actually seen these sort of tech companies say, it's actually better for us to do business with a Digital Realty during these times rather than spend $1 billion on our own money, especially when debt is higher, and use a third-party provider as well. So I think those have been some of the elements that have impacted us. But as John and I always say, we're a management team focused on long-term value creation and not short-term changes in our stock price or unit price, and we strongly believe in our strategy.
Thank you for the macro view insights that you have shared with unit holders. More down-to-earth question from a particular unit holder. And he reads, how well do you know the tenants in the target properties? Have you done due diligence on the tenants? Would there be a repeat or failure of tenants soon after IPO for proposed transaction, i.e. loss of tenants after the acquisition?
Dan, do you want to take that one?
Yeah, as I kind of alluded to before, we definitely did all our diligence in the sense and look at, I think the Frankfurt as a highlight is over 90% hyperscalers are investment grade, right? As I think John highlighted in his presentation, the tenant profile is actually increases our investment grade exposure. So these are high quality tenants with high investment grade ratings, strong balance sheets as well. So John and I definitely diligence not only if they're a public company and their financials, but we also diligence with local asset managers, operation team members about how these customers are interacting, what they're doing in the local market, are they getting new business and buying new business, and the strength of the business today. So we definitely went down to customer level, property level, lease level in terms of our diligence to making sure that we got the best assets for our unit holders.
Right. A particular shareholder has also inquired about the the overall strategy of Digital Core REIT. What are your strengths? What markets are you strong in? What's your competitive advantage? What is your target geographic split, so to speak? So perhaps you can share a bit more on your competitive strengths and your overall strategy.
Sure. I'll start again, and Dan, please chime in if I overlook anything. In terms of the overall strategy, it's investing in core data centers in global markets. So we don't intend to stray afield of our focus in core assets and core markets. In terms of our strengths, I think it's a few things, including I think the underlevered balance sheet today is certainly a plus. I think we're fortunate that this business is driven by strong secular demand drivers. So, we provide an opportunity for unit holders to own a security that is backed by hard assets, but also has leverage to the digital economy. So I think that is unique. And last, but certainly not least, I would definitely emphasize the sponsorship, and specifically the fact I think we're really unique, especially in the Singapore market, in terms of offering exposure to the data centers as an asset class, but being sponsored by a leading global owner and operator. And again, I come back to the customer bankruptcy situation, and the fact that I think that we're going to skate through that, relatively unscathed, is entirely due to the strong support, not only stepping up and providing the cash flow guarantee, but more importantly, the 4,000 customer relationships that that provide the opportunity to backfill that. I think anybody else who's more of an asset manager would have a much tougher time actively managing a vacancy in an international market like that. As far as what markets we're strong in, I would certainly for the IPO portfolio, I would point the two. Look, all these markets are pretty healthy, but in particular, Northern Virginia and Silicon Valley. Those are in Northern Virginia. I think we've been a little bit fortunate that market has tightened up very considerably. New supply has just completely dried up in Northern Virginia. A little bit like the situation you've got in Singapore, where the government imposed a moratorium and said no new data centers. That same situation has kind of happened recently for different reasons in Northern Virginia, and that of course it's Digital Core REIT's largest market. It's also the sponsor's largest market, so we have a very deep presence in that market. And as far as geographic splits, we don't have specific targets on the pie, but I can tell you that we have a global mandate, and we certainly we aspire to have a globally diversified portfolio.
Well, thank you for sharing the strategy of the Digital Core REIT. Unit holders are also concerned about what's your approach in reducing the debt level with reference to interest rate hikes, and what sort of gearing ratio would you be comfortable?
It's a great question. Maybe I'll take that one. So one is we actually purposely came out with an under-levered, low debt level balance sheet. I think when you look across the S-REIT community, most S-REITs, are kind of around that 37, 38, 40% gearing. We came out of IPO, at 26% gearing today. That gave us flexibility to, one, pursue a modest acquisition like we're doing today with the Frankfurt acquisition being proposed. Our target levels will be somewhere around at 35% to 40% level as well, but we're mindful of where the environment's going. I think it's also important to keep in mind too that our debt maturities, we have no debt maturities over the next 3 years. So there's no refinancing risks with our debt profile. We're also still low gearing when compared to our peers. So we think our balance sheet, as John highlighted, is a key strength of ours and one that we intend to keep and maintain. And I think you'll see with this transaction, even after the transaction, we're still well below kind of our target levels as well.
Right. Thank you. A unit holder has asked a follow-up question regarding your interest rate. The unit holder observed that you have hedged 50% of interest rate risk. Now, what would be the sensitivity on DPU for every 1% change in the interest rates?
Yeah, it's a great question. So for every 1% change in the interest rate, it'll be roughly a 3% impact to DPU.
Right. And another question from a unit holder. Can you share with us the details of the cash flow backstop arrangement with the sponsor? Is this a form of cash flow borrowing which has to be repaid at a future time? Or is it a guarantee on the loss of revenue which does not require to be repaid?
Sure, I'll take that one. So it is a form of cash flow borrowing, which has to be repaid at a future time. But there's a couple of things that I think make it particularly unique or advantageous. Number one, it's interest-free. So there's no, regardless when we pay it back, there's no interest due. Number two, we have the ability to settle it in either cash or units at our option. And number three, we've got 5 years from, basically 6 years from today to pay beginning. So we wouldn't have to start paying anything back if we even have to draw it down. We wouldn't start to pay back until the beginning January 1, 2024, and then we'll have 5 years to pay it back. No amortization or maturity schedule. We can pay it back anytime at our option over 5 years. And really the benefit of that is that hopefully in the next 6 years, we will grow significantly such that, the $5 million impact is going to be a much, much more manageable. It'll be hopefully a drop in the bucket and not an existential threat to DPU. So, and we've got we've got the ability to feather it in anytime we've got an outsized quarter, a beat, we can pay a little bit back. So they gave us tremendous flexibility, again, demonstrating the sponsor's strong commitment to Digital Core REIT.
Thank you for your sharing clarification. Now, there's a question on rental revisions. Do you expect the rental reversions to cope with inflation cost pressure in the next 2 years?
Yeah, Dan, why don't we tag team this one as well? I would say my first couple of points to that would be to emphasize that, we have limited exposure to inflation, given the fact that most of the expenses are passed through to customers. So that's kind of the first line of defense. I do think, quite frankly, again, I just described what has transpired in Northern Virginia. So our nearest term expirations, which are in 2024, are concentrated in Northern Virginia, and rents in that market have spiked. So there's been a very significant double-digit increase in market rents in that market. So there should be an opportunity for positive rental rate reversions when we begin to have some rollover in 2024. Dan, anything I left out?
No, it's just supplement that is that, John highlighted over 60% of our portfolio is triple net. So we're not exposed to any rising costs that our customers have to pay for operating expenses. And in addition to that, our contracts have built-in rental escalations, and they range anywhere from 1% to 3%. And so that's built-in kind of rental growth to offset any rise in expense as well. So we think we're very well insulated in an inflationary environment.
Thank you. A unit holder has asked a question, and that tech titans are setting up their own data centers. Now, will this be a significant threat to you?
Yeah, I think Dan kind of already touched on this. I'll try to add my perspective as well. But again, I would underscore tech titans have been building their own data centers for years. This is not a new, absolutely not a new phenomenon. This has been going on for years. In fact, they actually build a lot more for their own account than they lease from third-party providers. But even so, like what we see is really just the tip of the iceberg. But that tip of the iceberg is so big that there's tremendous opportunity. And as Dan pointed out, the sponsors' 3 best quarters in terms of new business from tech titans have been within the past 12 months. So they're doing tremendous, and it's not just the sponsor too. If you look across the industry, each of the competitors is really putting up record bookings. So demand is clearly very robust. And it's not just limited to tech titans too. We're seeing a significant contribution from what we would call enterprise customers as well, in addition to we often refer to the tech titans as hyperscale or service providers, cloud service provider customers, but it's not just concentrated. They're the biggest, but they're far from the only game in town. And I would argue that it's definitely not a threat. It's an opportunity. And there's an awful lot of business for us to do with them in addition to what they do for their own account. I'd also point out the tech titans are very good at setting up their own data centers in their own backyard, right? They have a much harder time developing data centers in a place like Singapore, right? Which happens to be Digital Realty's regional headquarters. But really what I mean is those tech titans, they've got large corporate headquarters in the Pacific Northwest, and there they have a very good handle on engaging with municipalities and zoning laws, and they've got the corporate infrastructure to actually develop. But it's really not, developing data centers is not their core competency. And so especially when they go to global markets like a Frankfurt or Singapore, they generally don't have the scale to develop a real estate construction project. And they may not have the size requirements in a given market that really justifies them to build for their own account. So there's plenty of, this is not a new trend, and there's plenty of business for us to do with them around the world.
Thank you for the clarification and elaboration. Unit holders have also inquired on your current and future share buyback plan, if any.
Dan, you want to take that?
Yeah, so our current buyback mandate is 10% of our units. Obviously, there's some restrictions currently while we're out here with the EGM next week and the proposed acquisition. And once those restrictions are lifted, obviously this is a element for accretive investments that we could look at. We're at the current trading prices today of our unit. So that's definitely an examination for us. So it's 10% of units outstanding. And also, obviously, there's some restrictions currently while we're contemplating this acquisition and the EGM. But once that's lifted, then we'll have no restrictions.
Unit holders are also, inquiring on your acquisition criteria. They want more specifics. For example, the typical size of the acquisition, market, catchment area, physical attributes, etc. Now, would you be able to shed some light on this, on your acquisition criteria?
Dan, will you lead on this one, and I'll chime in?
Yeah, so there's a couple of qualities of assets, right? So one is when we say stabilized, we really mean 90% occupied. So now obviously John and I are looking for assets that are well occupied, and this is kind of in this portfolio where Frankfurt's 91% occupied today. Two, we're looking for assets that the current rent in that property is at least comparable to current market rents. Three, we're also looking for assets that have minimal kind of CapEx needs or maintenance CapEx needs over the coming 2 years. When we think about size, that question is a very big question, but I actually think the benefit of the sponsor and what we can do is that we're not restricted to size, right? I think sometimes you're forced to take such a big size and you actually don't have the funds or the money to pay for it, right? And we're kind of seeing this current market today where, John and I laid out a menu where he said, we can buy a 700 million of data centers or 140 million. And obviously with the stock prices today, we say it doesn't help unit holders to buy something so big in this market. So we can buy something much smaller at 140 million. And I think that's a unique thing that we can do with our sponsor to change and do what's the best value, because, I think we don't want to grow for just the sake of growing. I think that's where people get in trouble, right? And it also creates less DPU growth and creates dilutive actions. We want to make sure that whatever we do, every dollar we spend puts more dollars into unit holders' pockets, right? And I think that's why our criteria actually is the fact that we have these criteria on the types of assets we look at, but also it's really about what delivers the best value into not only short-term growth, but long-term value. And I think that also goes in with the geography mix question, right? We have a global mandate. We're not restricted to any one market. And, John and I will assess which market makes the most sense, what gives us the best DPU accretion, right? And we think, the assets we identified in Frankfurt and Dallas deliver a strong DPU accretion, but that's in the future, we could also look in assets in Asia Pac as well and other markets. So I think we have a wide, set of data centers to assess and pursue. And I think our criteria really, if I had to simplify it, is to put more money in unit holders' pockets with every acquisition we do.
That's really well put, Dan. I'd maybe chime in a couple of points. I would say, number one, following on Dan's point about geography, I'd say core markets. And what we mean by core markets is really markets where we have repeat customer demand, right? Not just a one-off situation, but repeat, robust customer demand. I would say also, Dan hit the nail on the head, but we're obviously looking for an attractive valuation and ability to generate accretion, and at the same time, not going to sacrifice the balance sheet, right? So not going to lever up to do a transaction. And we're also looking for tax efficiency, right? We don't want to take on a lot of tax leakage. So those are some of the criteria that we look at. And finally, I would point out a lot of what went into this particular portfolio that we teed up was what it does for the overall platform. Again, in terms of size, scale, diversification, customer mix, geographic mix. So it's not just the individual asset itself, but what it does for the overall puzzle.
Right. Picking up from your question on core markets and long-term view, particularly unit as us. So can the market expect that there are potential pipeline acquisitions, from the sponsor?
Oh yeah, no, I mean, we've identified a $15 billion pipeline from the sponsor. I think maybe what the question's getting at a little bit more is, can you be more specific in terms of what's next? Dan, do you want to kind of give us a little bit of flavor in terms of what we're thinking about?
Yeah, so you kind of see today what we announced, which is obviously we think Frankfurt is a great asset. As John said, on current forming where we are today, we're going to acquire 25% of that. But obviously we think acquiring more of that makes a lot of sense too. So I think that's probably a near-term identified pipeline, and that shows you the flexibility that we have. We can go from 25% to 50% to 80%, right? And I think, we're definitely keen on looking at further international expansion. We also realize that we are a Singapore-based company, and obviously having Asia Pac or Asia-based assets is also going to be critical in the long term. But at the same time, I think this is all balanced with what delivers value for unit holders as well, right? So we want to maximize DPU accretion and value for unit holders for every single acquisition we do. So I'd say like we internally have a list. You know, as John said, there's a $15 billion pipeline, and we have multiple tiers of assets we look at. But obviously that can change every day, right? That the markets are very fast moving, interest rate environments are fast moving, economic factors are fast moving. So we maintain flexibility about how we assess and make sure we don't stay locked in on one thing when the world's changing around us, right? And that was a critical aspect of this. So Europe was one asset that we were like, this is great. Then the energy crisis happened, and we were like, does it still make sense? And then obviously we looked at the customers, we looked at the contracts, and said we're covered from energy issues. It still makes a lot of sense, right? So I would say we don't want to keep a blind eye or closed view on what we look at. We want to make sure that we have priorities and that we always relook at those priorities based on new facts in the market.
Thank you, Dan. One particular unit holder has asked about your interest rate risk management policy, in particular your hedging policy. So what percentage of your total borrowings will be hedged? For how long? And in addition, are the borrowings on property level or portfolio level? Are they taken in US or in Asia or Singapore, where it might be relatively cheaper?
It's a great question. So obviously, you know, we sent out with kind of a fixed rate hedge strategy on our debt today. With the debt funded transaction, we're actually going to move up to 64%. We're going to continue to look to increase that over time. We're looking at additional hedges, you know, ahead of next year as well. I think that's very critical as we look to kind of mitigate potential changes and further changes in interest rate environment. Now, in terms of our debt profile, our debt is actually 100% unsecured, which means it's at a corporate level. It's not at a property level, which gives us great flexibility. And the current loan that we have today is that it's a US loan, but we think it's very attractively priced. But the new loan we actually have is actually going to be a European Euro term loan. And that Euro loan actually has also very attractive, much more attractive rates as well, just based on the interest rate environment there versus the US. So we are definitely going to, as you tied into the last question, we're going to look at financing markets as well, in terms of what makes the most sense to finance assets in various parts and geos in the world. And then the Euro term loan actually has a very attractive interest rate versus what we probably could get in the US today. But we do think that the current US term loan we have in place today is very attractive.
Thank you, Dan. Now, some questions have now been raised in relation to equity fund raising. When will the manager be making a decision on the potential equity fund raising, and what are the factors that will be considered?
Dan, you want to take that?
Yeah, so, you know, obviously we're examining the markets today, and the unit price today does not make any sense, right? So our main governor here is, you know, looking at equity or raising equity at or around NAV, and we're very far from that today. If the EGM approvals all go through, which we're, you know, hopefully get the support of everyone here today on the resolutions, we would have effectively 3 months post EGM to consider any sort of equity deal. But I can tell you that John and I, again, are very mindful of creating long-term sustainable value for our unit holders. So until there's a material improvement in our unit price, we won't be issuing any equity. If anything similar to the questions being asked today, we will be considering potential share buybacks.
Right, because I think unit holders have observed that as of September 30th this year, the adjusted NAV per unit is 84 US cents. On SGX, the REIT has been trading in the low 50 cents range. So they are wondering and concerned whether when would be a right time, and is this the right time to do an equity fundraising when the unit price is low, and would there be undue dilution if there is any equity fundraising at this time?
Yeah, we definitely not be doing equity fundraising today, and at the current prices today, it would not be accretive to unit holders, so we would not proceed with that, right? So obviously, we're waiting until there's recovery in our unit price, but again, we're focused on long-term growth, including DPU growth for our unit holders before we proceed with any capital raise.
Right. Hopefully, the message has come across loud and clear.
Right. Unit holder has asked about the issue of ESG and how are your data centers designed, or you know, such that it reduces energy usage. Would you comment on that?
Dan, will you kick that one off?
Yeah, so obviously energy use at data centers is a very big topic, right? Because we use so much energy. Now I'll talk broadly about the sponsors portfolio, but there's various things you can do, big and small. I think on one side, it depends on where you operate in. If you're operating in a colder climate, such as in Europe, you can actually in the winters turn off the AC and use the cold air to help cool your data centers, right? When you're in a tropical environment such as Singapore, that doesn't quite exist because it's always warm. So obviously you look at things like installing solar panels on top of the roofs. You find more creative ways to use like a turbine generator to drive down the improved efficiency. And you also do small things, like you clean up the water tank so that the water flows more easily and improves efficiency and there's less waste. So as an operator and as a global operator of 300 data centers, Digital Realty has looked at every single possible thing, big and small, to improve the efficiencies of our data centers. And I would also like to highlight that with the 2 assets we're looking to potentially acquire, they're actually renewable energy source, right? So it's the one in Dallas, we've actually have a contract with a wind farm where this wind power generated that actually helps put new power, clean energy power into the grid and electricity providers as well. So there are various elements that we can go out there, and we are very much conscious about the environmental impact that data centers have on the world, and are always looking for various ways, big and small, to improve the efficiency as well as the sustainability of our operations.
Right, and thank you. There's one last question on the Celtic mix of equity fundraising versus debt acquisition, because I think we hear that this is not the best time to do a equity fundraising. So is there a dynamic or Celtic balance between pure debt acquisition versus a mix of equity fundraising kind of funding to do your acquisition? Is there some explanation or clarity that you can shed? This will be I think the final question.
Yeah, so on the debt side, there's only so much debt you can put on or use all debt, right? Because again, it goes back to the leverage question. What is our gearing? And we do not want to go and buy something so big and use all debt and have our gearing go above 40%, right? So that's kind of the main governor that determines how much debt we're going to use to fund an acquisition. And then once you hit that threshold and that level, the rest of that will be equity. So right now in the proposal that we had was we felt comfortable to take gearing up to, debt fund is near 33%. Then we said, we want to go bigger. Let's maybe look at raising equity. But we don't have to raise equity, right? And right now the equity capital markets do not make sense. But at the same time, we're not going to pursue a large acquisition and take our gearing and our leverage so high that it endangers our balance sheet. We want to protect our balance sheet and preserve it and make sure that it's flexible for future growth.
Yeah, so just to be clear, what we're contemplating today, $140 million investment that would be entirely funded by debt, no equity fundraising, and that would be 2% accretive to DPU, and that 2% accretion has been locked in by virtue of the interest rate swaps that Dan has already executed. Right.
Thank you for the very detailed explanation. We are coming to an end of this virtual dialogue, and I would like to invite management to have some closing comments before we end the dialogue session.
Well, I would just like to thank you again for hosting us, and likewise thank our unit holders for their support and patience. And I would ask you to bear with us through this difficult year. Like I said, I think Dan and I have a high degree of confidence in this particular acquisition and the future for the data center industry and Digital Core REIT. So thank you again, and hope to see you soon.
And before I close the session, I would like to remind unit holders that the EGM will be held virtually on 18 November at 10 a.m. Singapore time. So I do urge unit holders to attend the EGM and make your decision known. All right. Thank you and good night.
Thank you.